If the Federal Reserve goes, will the banks follow? All told, the Fed's new loans and credits easily exceed $1 trillion, which dwarfs the $335 billion committed by the Treasury Department under the better-known Troubled Asset Relief Program, or TARP, T-A-R-P. Until recently, most of those loans, including those used to rescue Bear Stearns, Citigroup, and AIG, have theoretically been justified as fulfilling the Fed's traditional role of lender of last resort. So then, to prevent panic, government central banks prop up financial institutions deemed too big to fail or acquire securities in markets where a seller's stampede overwhelms buyers. And now even this justification is being let go. In November, the Federal Reserve announced more new loans, purchases of up to $600 billion of home mortgage-related securities and $200 billion of securities consisting of auto, credit card, student, and small business loans. And there was no pretense that these markets also verged on panic buying and selling, a mass psychology of panic and fear markets based on fear. The Fed's new lending occurs through programs with baffling names like the APCP, MMMF. The mumbo jumbo aside, the Fed is lending in new ways because the old ways just aren't working anymore. Nothing seems to be working. The economy just keeps getting worse, day by day. Traditionally, the Fed has reduced interest rates by cutting one short-term rate, the Fed funds rate, on overnight bank loans, and assuming that by making credit more abundant and cheaper, other rates on consumer and business loans would presumably follow. But that hasn't really happened, has it? Since September 2007, the Fed has cut the Fed funds rate from 5.25% to 1%. And there's not much lower to go then, is there? But some other rates have actually increased. High-quality corporate bonds were a percentage point higher in November than at the start of 2007, and some loans are unavailable at any rate, period. And some parts of the credit market have simply just shut down. Yes, the economies of the world are starting to shut down in some kind of way. So, traumatized by losses on subprime mortgage securities, many investors shun all forms of securitized lending, loans packaged into bond-like instruments. In 2006, securitized auto loans averaged almost $7 billion a month, but last month they totaled only $500 million. That's quite a difference. So, without an ample supply of car loans, fewer cars will be sold. For a while, greater bank lending partly offset collapsing securitization. But no more. Fearing higher losses on consumer and business loans, banks have tightened lending standards and are hoarding cash like there's no tomorrow. From late October to mid-November, bank lending dropped by $162 billion. So, the Federal Reserve Chairman, Ben Bernanke, faces a rare, if not unprecedented, situation. There's never been a time like this, and there will be a time like this again. Despite the Fed's frantic efforts to relax credit, it seems to be tightening in the midst of a very harsh, increasing recession, the opposite of what's wanted or needed. And private behavior is neutralizing public policy. All sorts of lenders are terrified by losses and the fear, yes, the fear of what they don't know. A market based on fear, chaos, confusion. The sudden failure of Lehman Brothers in September compounded their anxieties. Having once had too little appreciation of risk, subprime mortgages, for example, lenders may now have too much. The danger is that tight credit and consumer pessimism combine to lower spending, raise joblessness, and cause even more defaults. A spiraling downward, or the ripple effect outward. So the Fed is struggling to mitigate this sort of downward spiral, supposedly, somehow. There are offsetting forces. Lower oil prices bolster consumer purchasing power, but only a little, because only the oil prices seem to be going down the most, which makes no sense at all, really. The Fed's latest announcement on buying mortgages pushed rates down, stimulating more demand to refinance old loans, thereby reducing consumer debt burdens. But then again, it's widely expected that the Fed will ultimately cut the Fed funds rate to zero, and then, by buying long-term Treasury bonds, try to push down longer-term interest rates somehow. In other words, they don't really know what they're doing. They've never had anything like this before. The economy is seizing up. Yes, it's seizing up in some kind of way. It's shutting down. The economies of the world are starting to shut down. That's what it appears to be. All this is a vast and daring monetary experiment. Yes, an experiment, global in scope and fraught with many hazards. The new money and credit issued by the Fed are created out of thin air. If the Fed is too timid, it may deepen today's slump. The financial magazine Barron's, hardly a socialist bastion, suggested the Fed should balloon its credit to an astounding $6 trillion or more. But too much money and credit might someday boomerang as higher inflation. Well, we have inflation and deflation now. Socialism and capitalism, a form of all those things, mixed in to the mix. Considering the consequences of being wrong, Ben Bernanke faces an enormous intellectual challenge and no less an agonizing personal burden. And amid the hoopla over Obama's economic team, it's worth remembering that Bernanke's role will be pivotal as he stays on. Already, his Federal Reserve has invented more economic tools than in any comparable time or period of the Fed's 94-year history. The supposed object to prevent a broad credit collapse. It's already collapsed some way, though, in some kind of way. So, yes, these are more signs of the times, and this is like a time like no other. In other words, there's something fundamentally wrong with the economy of the United States, or the economies of the whole world, actually. It's all based on the wrong things. Greed. Pure greed. Yes, greed has brought this upon all the nations of the world. And not planning ahead. No real long-term planning or solutions to what's to come. And on top of that, there's more to this all. Something much bigger is coming. Real change must come. And all these are connected or interconnected to one another. Everything is connected. Things don't happen in a vacuum by themselves. Everything really is connected. And these are all more signs of the end times, transition days. And there are many, many signs. Once again, just look around.